Profits associated with the business, and the production costs and the theoretical illustration models of production costs along with any economic analysis in the production process of goods and services. We're looking to have the idea as the firms themselves are important employers of individuals and the factors of production. Business firms employ factors of production that include land, labor, plant, equipment, resources in order to produce goods and services to be sold to consumers that consumers can find useful and generate a particular experience. The business firms employ individuals and generate a collective well-being for society by providing a service, a good, or an experience along with generating employment in the market. To do this, we need some form of market coordination. And market coordination is extremely important as individuals themselves perform tasks such as producing certain goods and services. And we're looking at the basis of market forces. The supply channels supply the goods and services and the inputs to produce a good or service, and the demand channels by consumers and households demand the product. If we have the supply and demand twin forces working together, the product is produced and the product is consumed at an agreed market price, which in this case benefits the consumer and benefits the producer or the individual firm in this case. When we're looking at the business itself, businesses essentially generate revenue and that can translate into profit if the product is successful. The traditional business profit formula, it's the total revenue of goods and services, the price of goods times the quantity of units sold, minus the total cost of operation. And the business profit can be broken into two subcategories. Accounting profit, which is traditionally business profit, it's the total revenue minus the explicit costs of producing goods and services. An explicit cost is anything that the business incurs as an actual cost in monetary value that can be accounted for, and any depreciation of assets. And then we have economic profit from an economic standpoint that signals a little bit more of the cost factors that a business incurs. So economic profit is related to the condition of the revenue that is generated by the firm in the sale of goods and services, minus the explicit costs, which include the cost of operations, minus any implied costs, foregone costs that are often overlooked or overseen or implied that are within the production capabilities of a firm, and any depreciation of assets. As you notice, economic profit has a little bit more to account for, so therefore they could be lower in some situations. Now, in the cost perspective, explicit cost is anything that directly costs money to the firm or to the individual person. Anything that requires a direct outlay of money, monetary outlay, monetary spending. Anything that has to do with the cost of resources, wages, the actual products, inputs, and so forth. Those are direct costs. Implicit costs, it's more of an estimated value that is foregone. It's an opportunity cost of using your cell phone resources and the value of the next best use. Think about this as the foregone benefit of using one's resources. It's an implied cost. And we're going to use implicit costs to estimate economic profit as sometimes the opportunity cost of using cell phone resources and the value of the next best use could be quite substantial. So implicit cost is something that is implied as an estimated value. So that's what is often omitted and left out because it's an implied estimation that it may not necessarily be included in some situations, but it's important. Now, if we look at the difference between economic profit and accounting profit, the total revenue is present in both. Explicit cost is all of the explicit items that can be accounted for in a business to generate the accounting profit, everything that can be measured monetarily speaking and that has a direct estimate. And for economic profit, the total revenue is the same, but you're looking to add an implied cost, which increases your costs, collectively speaking. Your total opportunity cost, your total cost here is increasing. So therefore, your economic profit may be a lot smaller than your accounting profit, depending on how it's analyzed. Now, suppose you have Tommy in this case, and Tommy is a professional that is currently working at his active job that pays him $60,000 a year. And Tommy decides to start his own furniture store after he inherited $100,000 from his parents. Now he rents a showroom for $15,000 a year for explicit cost, and then he purchased the capital equipment that cost him about $40,000 and has a depreciation rate of $5,000 a year. Then he went on to purchase furniture that cost him $60,000, and instead of using the $100,000 of the capital for his own business, instead of using the capital that he bought for his business, he could have rented some of it to an additional firm and earn a $5,000 a year return by renting it to someone else. And he earned $150,000 pretty well during his first year of business. So let's calculate Tommy's accounting profit given the conditions, and let's calculate the economic profit, and we're going to see the difference in both. So when we're looking at the accounting profit is crucial because we have accounting profit is the revenue of $150,000 minus the explicit costs. And notice how we have a lot of different costs here that we need to assign accordingly. The revenue is simple. It's $150,000. So we have $150,000 minus the cost of operations, which is the $15,000 in capital equipment minus the $15,000 for his showroom minus $40,000 for his plant equipment and capital equipment, and his $60,000 for all of the furniture that he's going to sell, minus the depreciation of the capital, maybe it's the infrastructure for the actual showroom. So he has a total calculation cost of $15,000, $40,000, $60,000, and in this case, $5,000. His net accounting profit is only $30,000. That's how much he's making after accounting for all of the explicit costs. If we account for economic profit, for practice, you need to calculate accounting profit that includes the revenue, all of the explicit costs, all of the depreciation. The depreciation is added in here. It's also there. Depreciation is added. Where is the depreciation? Here's the depreciation. And you need to also include the foregone benefits or the estimated values that he could have earned. What are those estimated values that are foregone? Well, he's foregoing $5,000 for potential earnings that he could have earned by leasing or renting some of his infrastructure, $5,000. And he's also foregoing his potential salary of $60,000 since he quit. So he's foregoing that. That's a foregone benefit and implied cost. So he has an additional $65,000 cost. $60,000 from his job that he left, and $5,000 from the foregone estimated values of the potential capital rent equipment revenue that he could earn. So you need to still account another $65,000 here in order to calculate the economic profit. So for practice, make sure to calculate that profit, and you will see the difference in accounting profit and economic profit as well. Now, in the production process of goods and services, we need to consider what is being produced, the inputs that are produced, and how to produce goods and services. So the production process in this case is the production of goods that is produced by having a relationship between the quantity of inputs that are used to produce a good or service and the quantity of output that is generated in the production process. Any production of goods and services requires inputs, a combination of inputs or resources, and also it produces a specific output of that output that is going to be generated. Now, some of those inputs are fixed, things that cannot be changed, that are consistent, that are always fixed for a specific period of time, and those are typically like land or natural resources that are fixed to some extent, or some form of infrastructure that is fixed for a period of time, and variable inputs that typically tend to change, things that are adjustable based on the production abilities of the firm. So think about inputs as land that is fixed, the fixed amount of land, and variable inputs, think about labor as the two primary fundamental pillars of production, land and labor. Land and labor to cultivate the land. So the labor, it's the variable input, and the land is the fixed input. So let's take a look at our simple production process if we are cultivating wheat, rice, corn, using our simple land and labor units to produce a particular good or service. Now, if we look at the long-term abilities, in the long run, all of the inputs, the majority of the inputs can be changed and can be adjusted. If we own a small farm, we can always increase the amount of land size to the firm or to the small farmer and adjust the acres of the land along with the labor units. So in the long run, the natural resources can be fully discovered to its full ability, although they still are limited, but you increase the concentration of it, you increase the usability of them as well. In the short run, we have at least one of them that is fixed. At least most of the time we have one or a couple of inputs that tend to be fixed, but in the long run they can be adjusted and they can be used to a greater extent or optimize their usability. Now, we're going to illustrate this graphically by showing a total production curve within the production function that shows how the quantity of an output, any output produced, depends on the quantity of a variable input, like labor, for a specific quantity of output, for a specific quantity of fixed inputs. So the total production curve is the relationship between the quantity of output that is produced depending on the variable inputs for any given quantity of fixed inputs or even any given fixed resources. Now, if you look at our simple production function here, we have wheat that is being produced, wheat, rice, corn, anything that can be cultivated by the land, and we have our labor units. So we have our labor on the horizontal axis and our product, which is our wheat, on the vertical axis. This is the output, and we have labor, and what are we using to produce wheat? Land. So our production of the good or service, it's in this case due to a result of our labor units, which are 1, 2, 3, 4, 5, 6, 7, 8, and our output in this case is based on our variable inputs to a particular amount of land. So we have our quantity of labor, 1 through 8, and we have the output of each labor units. In this case, if you have no labor, it produces no output. 1 unit of labor produces 19 units of output. 2 units of labor combined, the 2 workers produce 36 units. 3 workers produce 51 units together. 4 workers produce a total of 64 units. 5 workers produce a total of 75. But some of you may be thinking, what is this extra line and what does this mean? The MP of labor, which is referred to as marginal product of labor, abbreviated for MPL, marginal product of labor, is equivalent to the change in the output over the change in labor. Meaning every time we increase additional workers, output is going to increase, and we want to know by how much is output increasing or by how much is output changing every time workers increase. So we're looking at the productivity of workers. Essentially what marginal product of labor measures is the productivity per worker or the additional output generated by an additional change in labor. So for instance, in this case, the second worker adds to output, in this case, 17 units of wheat. If you look at the total production of 2 workers, the total production of the 2 workers together is 36. Both of those workers produce a total output of 36 units. But just that second worker has a productivity of 17 units, which are his share. The remaining are produced by the first worker. And then if we look at the marginal product of labor of the seventh worker, the seventh worker only contributes 17 bushels of wheat. So this is the 6th and 7th worker. The 7th worker produces only 7 units. But 7 workers together, the 7 workers combined together, 1, 2, 3, 4, 5, 6, 7, all of them produced 91, but just the 7 worker by itself, just that 7 worker here from 6 to 7 and from 84 to 91, it produces only 7 units. So that's why we care about marginal product of labor, because it actually goes per unit of labor, or in this case for each additional unit of labor, how much output is generated in this case, or what's the change in output. That's the difference between total output and marginal product of labor. Total output is for total labor units, how many units can we produce. Marginal product of labor is what is the productivity of each individual worker. So marginal product of labor is very important. Marginal product of labor let us know the change in the quantity of output for every additional change in the quantity of labor. If labor increases by 1 unit, then we want to know how productive is that additional worker and how much output can that additional worker can generate. In the equation formula, it's marginal product of labor, MPL, is equal to the change in quantity, how much quantity changes, divided by the change in labor. If we add 1 more worker, what is the additional output that this worker can generate to the production process of the firms? And what we notice is that usually if we add too many labors or too many inputs, often cases they're subject to diminishing returns. This is referred to as the all-time saying that there may be too many cooks in the kitchen if we keep the size of the kitchen the same or limited. It's given that one of the inputs is fixed, holding everything else, holding the inputs fixed, increasing the amount of inputs may lead to a decline in the productivity of that input. So diminishing returns to an input means that when you have fixed factors or fixed resources in the production process of goods and services, if you keep the size of the kitchen limited to one size, if you keep the amount of land the same, but you keep adding inputs like workers and more workers and more workers, suddenly you're going to find workers that have nothing to do or that produce very little or in some cases no output. So this is referred to as diminishing returns to an input or diminishing returns to labor. The marginal productivity of that input, which in this case is labor, is declining and is producing a lot less and less output than the previous ones. Typically the first several workers are the most productive than the substantial next units of labor, depending if the resources are fixed. Again, the key factor here is if we have fixed resources. So consider the graph for marginal product of labor. This graph indicates the workers, 1, 2, 3, 4, 5, 6, 7, 8 workers, and their productivity. Marginal product of labor, it's the marginal productivity of labor or how productive is each worker. The first worker has a productivity of approximately 19 units. The second worker has a productivity of approximately from 1 to 2. The second worker has a productivity of 17 units. The third worker, going from 2 to 3 workers, it has a productivity of approximately 15. And the fourth worker has a productivity, just the fourth worker by itself, it's a productivity of approximately 13 units. The fifth worker has a productivity of approximately 11 units. And you notice that the sixth worker, 7th and 8th worker still have productivity that is positive, but it's a little bit less than the first 4 workers. Worker 5, 6, 7, and 8 are less productive than the first 4 workers, although their productivity is still positive, given the amount of fixed resources. So this is a diminishing returns to labor graphical illustration curve or analysis as to how sometimes workers are subject to diminishing returns. The productivity can decline, and essentially in some cases can actually be zero. If there's no additional resources, the actual worker could have negative or zero productivity. It happens sometimes. So the first worker generates this 19 bushels and the second worker generates 17, third worker 15, and so on, to the point that the 9th or 10th worker could produce none or negative output actually. So if we look at our graphical illustration here of productivity, our total output is on the vertical axis, quantity of wheat on the vertical axis, and our 8 workers are represented by the horizontal axis. And then this is our total production curve. Our total production for our 8 workers, meaning that if we have the 8 workers employed, 8 workers produce a total of 100, approximately 100 units, about 100 units. So the 8 workers have a total production, TP, total production. 8 workers have a total production of 100 units with 10 acres of land, for example. So if we have land available, that's the fixed input. It's important. How do we produce wheat? Why is this wheat being produced? Well, with labor. And what is the natural resource that is being used to cultivate wheat? Land, actual land. So the total production with 10 acres of land for our 8 workers is approximately 100 units. And if we want to know the productivity of each worker, here, worker 1, worker 2, worker 3, worker 4, 5, 6, 7, then we can actually see that our first worker produces 19 units, our second worker produces 17, our third worker 15. So all of those workers contribute to the production of 100 wheat, bushels of wheat for our 10 acres of land, and all of our workers have positive productivity, which is why it's higher. The question here is, how do we increase the total production of 10 acres of land to, with 10 acres of land, how do we increase the total production of 8 workers to a higher level? Let's say we want to produce 120 bushels, 160. How can we produce more? So if we want to keep the same amount of workers, we don't want to hire any more workers, we just want to produce more. And a lot of businesses are using this very basic concept. They may not be necessarily employing more people, they're actually optimizing the productivity of their workers by employing more resources. So we can increase the productivity of the workers, this 8 workers, by increasing the size of the fixed input. So with more land, which is a natural resource, each worker can produce more, can be more productive. If we double up the land from 10 acres to 20 acres, we can increase the production to 100, approximately these 8 workers can produce about 140 or more units. We double the size of the land. And this is a very basic, simple idea. If you increase resources, technology or capital or plant equipment to the same amount of workers, you can produce, in some cases, twice as much, or an increase in the total production, and have your same original workers be more productive. And notice that if the total production increases, the total productivity, the marginal product of each worker is also going to be higher when the size of the farm or the size of the land here is also increases. The productivity nearly doubles. So in this case, the green line represents that the marginal product of labor of 20 acres of land, it increases significantly. So you want to give more resources to your workers. And this is a fundamental pillar as to sometimes there's an issue as we are employing the same amount of workers but we're more productive. Yeah, just increase the productivity of those same workers and increase their production line. In this case, what they can produce. Give them more resources. To produce goods and services, we need laborers, resources, fixed inputs, variable inputs. And in the process of it, it requires paying for those resources or have costs. And we saw this briefly, the cost in the profit formula. The total cost of production of goods, it's in this case the total cost of producing any quantity. Anything has a cost. A lot of different things have a cost and things need to be covered. They need to be paid for. And the total cost includes the fixed cost, which is the cost of the fixed input, plus the variable cost, which is the cost of the variable units that are changing. And variable cost covers all of the factors that can vary and that can change based on the variable inputs. In this case, we're using labor as a variable cost factor and land as a fixed input and fixed cost factor. So when we're looking at the cost condition, the total cost is a fixed cost plus variable cost is going to be a linear summation. So it could be increasing exponentially since it's a summation. And notice how here we have the cost on the vertical axis since cost may increase. And output in this situation is on the horizontal axis, the actual quantity of output. So 19 units produced by the first worker, 36 units produced, the total production of 2 workers, 51 units, the production of 3 workers, 64, 75, 84, 91, 96. So we have here the workers 1, 2, 3, 4, 5, 6, 7, 8. And then we have the quantity of each. The first worker produces 1, 2 workers produce 36, 3 workers produce 51. Again, this is total production. 4 workers together produce 64. And then we have the variable cost here. The variable cost is what are we paying these workers? It looks like we're paying $200 for each worker. Each worker here has a variable cost of $200 each. Or any other form of variable cost that is incurred. Our variable cost is $200, $400, $600. And if you notice, our fixed cost is the same. $400, $400, $400, $400. Fixed cost, as it sounds, is the same. It's fixed. The land cost X amount of dollars is fixed. And if you notice here, if we have no labor, 0 units, if I have no output, 0 units, then we have no variable cost because nothing is being produced. But we have a fixed cost, which is the cost of the land, which is fixed. So our total cost is going to start not at 0. There's no such thing as a free lunch. It's going to start at 400. So that's our fixed cost just to start operating. If we produce 19 units, which is this one, well, now we have to pay labor fees or some other variable factor, and our total costs are going to begin to rise. So we have our total cost for no units is 400. If we produce 19 units, we have to pay a fixed cost and a variable cost, which is $200. So that's why our total cost rises. We produce 36 units. Now we have a variable cost of 400, so we have an additional $400, so it continues to rise. We produce 51 units. Well, 51 units have a variable cost of 600, and our fixed cost is still the same. It's 400, so it increases even more to 1,000. And notice how our total cost becomes steeper towards point G, H, and I. It becomes steeper primarily because cost of operations start to increase, and due to the diminishing returns effect of labor. So if you notice here, more labor units produce close to the same amount as the previous one, and we're subject to diminishing returns, but you still have to pay them about the same, which is making costs steeper, or costs to increase faster than the level of output. Now, we want to know exactly how much is cost changing at the margin for each additional unit of labor. We need to calculate marginal costs and average total costs for the average cost of the production of goods and services. So marginal cost here is the change in total cost, how quickly is cost changing, divided by the change in quantity. In this case, when quantity of output increases from one quantity to the next, that's going to increase our cost of operation. So we will need to calculate between those 2 points, or between the marginal points, the actual marginal cost of production. So marginal cost is referred to as the change in total cost generated by producing additional units of output. The graphical formula is marginal cost is equal to how much is total cost changing, delta, the universal symbol for change, divided by the change in output. So in this case, if we produce more output, cost is going to rise. So we want to look at the marginal change between those points, between output 2 to output 3. How much is that increasing our cost? So consider the production of salsa making, producing salsas. We have up to 10 cases of salsa that can be produced. We have 0 units, 1 unit, 4 units, 6 units, 8 units, 10 units. Our fixed cost is the same. It doesn't change, it's the same whether we produce no units or 10. That's how much we need to start producing the actual salsas and getting the equipment necessary to produce. And if you notice the variable cost, we produce no output, then it's 0. But it produce 1 unit of salsa is 12, 2 units, it rises to 48, 90, 182, 300, 488, and 1200. The variable cost can include anything when it comes to the condiments, the labor, the amenities, and so on. Adding both of them together, fixed cost plus variable cost, gives us our total cost of operation. That's the linear summation. Total cost of 1 case of salsa, it's 108 plus 12. The first case of salsa, this is a case. This is an actual case. So when we do the average cost, you're going to see that the average cost of one salsa may be a little bit lower. But this is the actual case. So 120. 3 cases, 108 plus 108, 216. 5 cases, 108 plus $300 in variable costs, 408 total cost. 8 cases, 108 plus 768, we have 878. So our total cost is rising as we produce more. Some of you are saying, how is that possible? Why is total cost rising? Shouldn't costs decline as you scale production? Yes, but you're thinking of average cost, which is the next analysis. And if we look at the marginal cost here is equal to the average total cost divided by the change in quantity. So this is when we're looking at the margin. How much is that additional case of salsa costing the firm? So we need to marginalize our production process. If you look at the marginal cost for each case, if you go from 0 to 12, you already have a fixed cost of 108, but you just want to know how much is that quantity going to cost you. So you go from 108 to 120. At the margin, the first case costs you 12. At the margin, from 1 to 2, your cost increases or your cost changes, the change in total cost, from 120 to 156. So if you subtract 156 minus 120, you get 36. And how many additional cases of salsa we're producing? Well, we're going from 1 to 2 or just one more. So the second case of salsa costs the firm $36. The third case increases your cost from 156 to 216. So the additional case of salsa, which is 2 to 3, increases cost or changes cost from 156 to 216, and it increases it by $60 because it's changing by 1. So when we're looking at the change in total cost, is captured here by marginal cost. At the margin, or for each additional unit produced, how much is total cost changing? Or total cost changes every time we produce additional units, or the change in total cost divided by the change in units. It can be analyzed by marginal cost. Both of the graphs, if you recall, they are increasing. Total cost is upward sloping, and the marginal cost is also rising slightly, but a little bit less since it's at the margin. And let's take a look at the difference and the distinction between total cost and marginal cost. The total cost of 2 cases of salsa, is about 196, something like close. Two cases of salsa is about 196. And the marginal cost of the second salsa, is about $36 here. A little bit less, so make sure to note that distinction. The total cost of 2 cases is about 196 or so, depending on how much was it in the back. Two cases of salsa cost you 156. That's how much 2 cases of salsa cost you, 156. The total cost of 2 cases of salsa is 156. The marginal cost of just that second case here, it's $36. So there it is. From 1 to 2, how much is the marginal cost of the second case? $36, which is graphed here. $36 for the second case. Now we look at the 8th case of the salsa. It's important to note here that the total production, it's different than marginal cost. The 8th case by itself, is going to cost you about 180, which is here, from 7 to 8. The marginal cost, again, the graph on the right, which is the marginal cost, is looking at the margin per unit, or in this case for additional units. So the marginal cost of the 8th case, it's going to be somewhere around 180. And then total case, the total production of 8 cases, those are 2 different questions. The total production of 8 cases is about $900, it's between $800 to $1,000 in this graph. That's a total production of 8 salsa cases. 8 salsa cases. From 7 to 8, or at the margin here, you're looking at an additional cost of 180, basically here, from 600 to 800. The 8th case by itself. Make sure to note the distinction of those 2. They're very different. What about if we want to find the average cost of production of a specific quantity? Not the total cost, not the marginal cost, but the average cost. The average cost of production, it's given by the average cost of producing a good or service and for any given quantity. So we take the total cost of production, average total cost ATC, and we divide it by the quantity of output or a specific quantity of output. So total cost is divided by the total quantity produced. That will give you the average cost of production. And it's usually U-shaped, meaning that the graphical illustration is not going to be a straight line that is going to increase, but it's going to be more of a U-shaped pendulum graphical illustration. The average cost of production here does decline. Since it's U-shaped, it declines at certain levels of output, and then it rises after a specific point, and it increases after at higher levels of output. This is quite interesting when it comes to the average cost of production. The average cost of production or the average total cost of production. It includes average fixed costs of producing goods and services, which is the fixed cost per unit. If you recall the equation here, the total cost is fixed cost plus variable cost. And if we do average costs, then we have to do average cost for everything. That's why we have average fixed costs here. Average fixed cost is referred to as the AFC. Average fixed cost is equivalent to fixed cost divided by quantity. If you want to know your fixed cost over the quantity, or this is referred to as a spreading effect, your cost can spread over large quantities of output. Fixed cost divided by quantity will give us the average fixed cost for a particular quantity of output. And then if we want to know the average variable cost, then we can also find the average variable cost per unit by dividing variable costs over the quantity of output. So the average variable cost, AVC here, it's the variable cost of operation divided by the quantity that we're producing, variable cost divided by the quantity, and that will also give us the average variable cost of producing any specific quantity of output. Now, combining this two, average fixed cost plus average variable cost will give us the average total cost, because we're averaging everything. So if you add them together, it's going to give you the average total cost, just like when you add total cost plus fixed cost. Just when you do total cost is equal to fixed cost plus variable cost, that will give you total cost of operations. Total cost is equal to fixed cost plus variable cost. In this case, average fixed cost plus average variable cost will give you your average total cost. I know there's some technicalities here because of the notations and formulas. And let's take a look at the average cost curve that includes the average fixed cost and the average variable cost into the graphical illustration. So we continue with our example of case production of salsa and the quantity of salsa produced. We produce up to 10 cases. But instead of looking at the total cost, we're going to look at the average cost of producing 10 cases of salsa. And the average total cost of producing 10 cases of salsa is actually going to be whoosh U-shaped type of look. It's going to be relatively downward sloping at first, and then it increases after a certain point. So it's a U-shaped look type of graph. It looks like a Nike symbol. Or in this case, however you want to look at this particular graph, is U-shaped. It drops first, and then it increases thereafter. And that indicates that the average cost of operation declines as you produce some units of output, and then when you reach here, 3 units or 3 cases, that's your lowest point on the average cost curve, and then it increases thereafter. After 3 units, the average cost of operation begins to rise. So this is often referred to as the minimum cost output, the minimum average variable cost point, at which you're minimizing your cost on average. On average, 3 units minimizes your cost of production, or 3 cases of salsa here give you the lowest cost on average. So average is the lowest, and you can produce 3 cases of salsa at the average cost of operation if you choose to. So this is the point where you're on average, it's less expensive to produce 3 cases of salsa for the production process of the firm. So this is the one that we're actually concerned, because if you notice, the total cost just continued to rise. It went up to 1,000 and more. But you still want to select a production line, a production quantity that you can produce, and based on this curve, when we account for average fixed cost plus average variable cost, it indicates here that at 3 cases of salsa, we are minimizing our costs on average to produce 3 cases of salsa. So if you look at the average fixed cost, we can consider as quadrant 1, average fixed cost plus average variable cost. That makes up the total average total cost here, since they're added together. Now, the average total cost curve has 2 main reasons why it's U-shaped. In the first quadrant here, it decreases for one main reason, and then after point M, minimum cost point, it begins to rise for a secondary reason. And that secondary reason is referred to as the diminishing returns effect. The first reason why it's downward sloping or why it has the downward sloping shape at first, it's due to the spreading effect. The average total cost curve spreads as you produce more output from 1 to 3. You can produce more output and your fixed cost declines on average. So it leads to the decline of the curve due to the lower average fixed cost. And after you reach that minimum cost point, or right in the center, you experience the diminishing returns effect. As the output increases, or the larger the output, 3, 4, 5, 6, 7, 8, 9, 10, the greater the amount of variable inputs that need to be employed and paid for and so on. So it increases your variable costs, and that's what pushes the curve up. So keep that in mind as to why the curve downward slopes and then upward slopes at first. There's two effects working there, the spreading effect and the diminishing returns effect. Now, when we're looking at the chart that illustrates everything, we have our production line of 1, 2, 4, 6, 8, 10 cases of salsa. Our total cost, notice how our total cost is here by itself. The total cost of one salsa, it's 120. Total cost of 2 cases, 156. Total cost of 3 cases, 216. Of 4 cases, 300. So our total cost is rising. Our average total cost, you take your total cost 120, divided by the quantity produced, 120 divided by 1, it's 120. Then you take the average cost, 156, total cost, divided by 2, that gives you 78, and the average total cost, you do the same thing for everything. For 3 cases of salsa, average total cost is total cost, which is 216, divided by the quantity of output, which is Q, 216 divided by 3, 72, and so on. And notice how the average total cost actually starts at a 120 on average, but since you're dividing it by the quantity of output, it declines, 78, 72. It's a lot lower than total cost, 75, 81, 90, 99, 123, or 130. It declines, and then boom, after 3 units, it begins to rise. And notice how your average fixed cost, since your average fixed cost stays at 108, and then you're producing more output, up to 10 units, on average, your fixed cost declines as you produce more output. And if you look at your average variable cost actually increases as you produce more output, because you need to pay more units. So it starts at 12, 24, 36, 48, 68, 108, 120. It increases. So those two, this one, it's average fixed cost plus average variable cost. It's equal to average total cost. Here it's 54 plus 24 is equal to 78. You can add this two and still get average total cost. So that's why one of them decreases and one of them increases. So they're working down and up in this case. So let's take a look at all of the graphs for total cost, average total cost, average fixed cost, and average variable cost to see how it looks. So notice how the average total cost curve is downward sloping, consistent with the model. So average total cost declines 120, 78, 72, 75. And the average fixed cost is downward sloping. And then the average variable cost declines, and then it increases after a certain point. Actually, average variable cost here is rising. So average total cost, downward sloping, upward sloping. The average variable cost is increasing. The average fixed cost here, it's declining. And then the marginal cost curve, we saw from the beginning that it was increasing upward. The marginal cost curve, important thing to know, it will always intersect the average total cost curve at the lowest point, at point M. Regardless of how the marginal cost curve looks, it will always intersect at the lowest level. That's the minimum cost output in that case. Then we can later on look at, this is more of a linear average variable cost, linear marginal cost curve. And the average total cost is U-shaped, and average fixed cost is declining. But later on, we can actually see that some of the curves can actually concave up instead of just staying the same. Now, the minimum cost output will always align in this case with the marginal cost and the average total cost all of the time. So at the bottom of the average total cost curve, it's the level of output at which the marginal cost always will intersect the average total cost curve at its lowest level. It doesn't change. This curve will not intersect here or here will always intersect at its lowest point. Now, the marginal cost curve is not always a linear line, as I mentioned. It often declines first and then it increases after. This is due to the economies of scale, or in some situations when costs decline and then begin to rise after. So when you're looking at marginal cost curve, they tend to decline from zero to some production level and then slope outward after a certain point. In the new production era in today's world, we actually see that a lot of firms are interested in minimizing their costs. On average, at the margin or the total cost, most of the time they tend to want to minimize their costs. Minimize costs and optimize their output and optimize production. So we're looking here, the new era of production is changing, and also the employment sector. So the more realistic curves of how these models look like actually look like this. The average total cost is declining, as in the realistic world, the average cost of producing goods and services typically is downward sloping. You want to produce at a lower cost or minimize your costs on average here at the lowest level. And also your average variable costs, you should decline your average variable costs since they rise. And notice how the average variable cost follows the average total cost very closely. They are two curves that are following each other very closely. The average total cost is always above, the average variable cost is below, and it follows the ATC curve closely. Average total cost, average variable cost curve. And the marginal cost curve is also going to look like a hook here, downward sloping. It declines first. It intersects the average variable cost point at its lowest level, average variable cost curve at its lowest level, and it intersects the average total cost curve at its lowest level as well. The marginal cost curve, this orange curve, it intersects both curves at their lowest points. These points are important. Later on, we're going to talk about why their importance is crucial. If the firm cannot cover on average their variable costs, it may shut down. If the firm wants to operate at a point where they can choose to minimize their costs, then this is the point of operations. Average total costs at the minimum level, it minimizes costs and is consistent with the marginal cost of production per unit. So in this case, why are the costs declining here? Marginal costs, downward sloping, average variable cost, downward sloping, average total cost, downward sloping. Well, there's a lot of factors, and one of them is the specialization of production, and optimizing production leads to lower costs on average. And then after certain points, if you notice after certain points, average variable cost, average total cost, after like a certain area, they begin to rise. Marginal cost rises faster at some point than the others. But once those benefits have been fully exploited, marginal cost begins to rise quickly, and all of the other costs, average total cost and average variable cost, begin to rise as well after a certain point. So this is more of a realistic curve rather than having linear costs. This is more of a U-shaped, nonlinear cost curves that we're going to see for the section on cost analysis. In the short run, a lot of things are constant and fixed, and in the long run, things can adjust. So in the short run, the fixed costs are relatively out of the firm's control and are the same. And in the long run, just like all inputs are variable, all of the costs can also change and can also adjust, and all of the variables can also increase. In the long run, the firms, consumers, households, essentially most individual firms have time to adjust, to increase costs, decrease costs, produce more, produce less, shut down, or enter the market. But in the short term, a lot of things are fixed. And typically, sometimes we cannot control the short term, or we can adjust to the short term. So when we're looking at that in the long run, the firm has, it can select different fixed costs of operations, or it can actually adjust the firm's fixed costs. It becomes a variable that it can choose based on the level of output that it wants to produce. And it can also adjust the variable cost of operations. So let's take a look at the long run average total cost curve, how it looks the long run. Meaning, consider the long run a year to 2 years, 3 years, or 5 years. Consider a short term, for example, less than 1 year. In the immediate short term, a month, a week, today, those are short-term effects. Today, a week, or a month, 3 months, those are short terms. 6 months, that's short terms. When you get to like 9 months, once you get to like 9 months, that's medium run. A year, that's long term. So the long run average total cost curve in this case shows the relationship between the level of output that can be produced and the average total cost when the firm has had enough time to select and chosen a fixed cost to produce any given goods and services. And that's important in the production process of goods. So think about here the production of salsa making. We have the production of the cost of production of salsa from 0 to 1,000 or so on, and then we can produce 3 units, 4 units, 5 units, 6 units, 7 units, 8 units, 9 units. So this is a short-term, long-term effect. In the short run, you can produce 3 units, and in the long run, you can produce 9, or vice versa. If you're already operating in long-term capabilities, you can produce 3, 5, or 8. So the long-run capability here is represented by the long-run average total cost curve, abbreviated as LRATC. The long-run average total cost curve, LRATC, long-run average total cost curve, LRATC, long-run average total cost curve, it reflects the capabilities of the firm to produce in the long run and any level of output. It can produce 3 units, it can produce 5 units, it can produce 7 units, it can produce 9 units. And it also consists of short-run fluctuations or short-term effects. If the firm wants to produce 3 units in the short term, represented by average total cost 3, the firm will produce 3 units for short-term capabilities on the average total cost curve 3, which is the purple line, or the purple curve, ATC3 for 3 units of output, and it can produce 3 units in the long run capabilities. In the long run average total cost for 3 units should be consistent with the short-term average total cost curve. If the firm wants to produce 6 units, then the average total cost should adjust to produce 6 units in the short term on the average total cost curve 6, and also in the long run, or the long run average total cost curve 6. Should always produce simultaneously on its average total cost for 6 units and the average total cost for 6 units in the long run. If it wants to produce more units, such as 9, for example, it can produce 9 units today, average total cost curve for 9 units, but it should also be prepared to produce 9 units in the long run as well. So notice how this long run fluctuation, or this long run average total cost curve, is a simultaneous effect of short-term production cost curve. Or actually, you adjust the cost of production based on your capabilities as a firm. You want to produce 3 units, your average total cost curve should be reflected for 3 units of production in the long term. You want to produce 6 units, your average total cost should be reflected to produce 6 units in this ATC 6, and also in the long run, and so on for 9 units. Now, the long run has various situations in which you can operate at different rates, which means you can experience increasing returns to scale, which means you increase production and your costs decline. Notice that from between point A and C, for the most part, you can increase production from 0 to 3 or 4 or 5 and experience increased returns to scale, meaning you can increase production at lower costs. If you operate somewhere in the middle between 5, 6, and 7, you may have constant returns to scale, which you have constant production, constant costs, or the lowest cost. Cost is relatively flat, it's constant. At 5, 6, and 7 is constant. And your output can increase from 5, 6, and 7 at a constant cost. If you look at after 7, 8, 9, the cost begins to rise. Average total cost increases even on the ATC 9 and even on the ATC 6. it increases, and that's referred to as decreasing returns to scale or diseconomies of scale. Decreasing returns to scale because if your cost is rising, your potential profits are declining, they're decreasing, and you're increasing output and your cost is rising faster. Those two are referred to as the operational points of the firm that you can operate at different stages. In this case, in the short term and in the long run as well. Economies of scale are typically reflected in the lower part of the curve when actually in the declining part of the curve when you increase production up to a certain point, and they're constant in the middle part of the curve when you have your constant costs at the same level and your production is rising. And these economies of scale means that you're experiencing higher costs as you produce more output in the market. So for this section, make sure to review the revenue, profit, and calculation margins for the firm, along with the cost analysis for each graph. Thank you, and I look forward to next time. Have a good day, everyone.